Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Ben Richards, welcome back to the Australian Investors Podcast.
Owen, always a pleasure. Thanks for having me.
It's good to do this again, as in, again, the same episode again, because the audio failed us last time. At least we get to do it in person this time.
Was it the best episode of all time? Best unreleased episode of all time?
I think it was, because normally the unreleased episodes are the ones that don't make the cut for quality reasons. So this is a completely different reason. Technical issues, of course. Today we're going to talk about a bunch of different companies, some tech companies in there, and we're going to recap on a little trip that you took over to the west of Australia, and you wore yourself a hard hat, which was...
Was that looking good, Owen?
Yeah, you were. Yeah, it's good, man. It looked, I don't know if you're on like the dock or the port, or I don't know what you're doing exactly, but you look like you're working. You and the Dome.
For once.
/ Luke Larrative, who regrettably cannot join us today. If people want to get a sample of your research, they can do that because you guys have just launched something called goodresearch.com.au. And correct me if I'm wrong, what goes into your fund, you write up research notes and you do all that. But because your fund is a wholesale fund, I mean, you have to meet certain qualifications for people that do just want access to the research ongoing, they can become a member.
Yep, correct. So perfect for self-directed investors that are just looking for ideas, really.
Yep.
We just write up 2 ideas a month, our best ideas. We're investing in them ourselves in the fund. But yeah, so if that's something of interest, we'll probably talk about a couple names today and give it a look.
Yeah, great. So I'll explain how you can get a free sample report from Luke, Ben and the team by following. There's also a link in your show notes if you want to book in a call with the guys and learn more about not just good research, but all the strategies and everything that's offered. Now, in the notes for this episode, we talked about this before, but you've got this comment that you've made via email to me. You said, Australia's deceptively fertile hunting ground for small cap technology stocks.
Yeah, it's actually something that you might have said a little while ago. I'm going to put you on the spot here, but I think you might have tweeted something that Australia, from a listed market perspective, is surprisingly punches above our weight when it comes to tech stocks. But it's just such a pity that a lot of them have either been acquired or listed offshore. Most recently, Canva, which is talking about a NASDAQ listing, and Altium's been taken over. Atlassian is obviously listed in the US, but Australian headquartered. And yeah, it's probably a long list of kind of small cap software and technology stocks on the ASX that started as sub 3 billion companies, which is kind of the loose definition of a small cap, and have grown into, ubiquitous large cap status. Xero, Pro Medicus, WiseTech, Car Sales, Life360 is a more recent example. And these are the kind of multi-bagger stocks that everyone's looking for, but they're kind of hard to find. So I think we're quite deceptive in that sense, even if the stats show that we're a lot weaker than the US.
Yeah, I think most people just look at the overall pie and they go, what's the geek sector by market cap? And it looks like banks and resources. But if you peeled back from the ASX 20 and you look, there's WiseTech, and then there's health tech companies like Cochlear, ResMed, some amazing businesses in there too. So I think people, I don't think we give enough credit to the Aussie companies. And if you look at some of these businesses, WiseTech, Xero, maybe not so much Xero, Pro Medicus, Car Sales, Afterpay, which got bought out a few years ago, obviously by Square / Block / whatever it becomes next. A lot of these businesses, even Altium held off for a very long time. It's typically when the Australian dollar is depressed, then these big US companies just come in and go, bang, we'll take that. Not always US, but typically US. And the ones that have held out are typically the ones that are founder-led.
Because they can't be bought.
That's it, yeah. And so you have an opportunity there. Now, before we get into these companies, there is another thing that you've written in this email, and you've alluded to some things that would be the common characteristics you look for in software companies.
Yeah, I suppose why is it an attractive space in general? A large number of these companies have recurring revenue from subscription products rather than one-off, where if you win your customer once, you've won them forever, rather than winning new customer every sale you make. So that's kind of the first point. And on the financials of that, what it does is it makes operating leverage a lot easier. So each dollar of revenue you get is increasingly more profitable. And a lot of these companies are also quite scalable. So it's kind of a confluence of factors that makes rapid earnings growth, earnings per share growth, more attainable than a lot of these industrial companies, particularly on the ASX. And so, it can lead to these long-term compounders that can really outperform the market.
Yeah, I think a lot of these companies we're going to talk about today, like Objective Corp, Catapult 2, maybe not so much Jumbo, but XRF, getting their razor and blade model, RPMGlobal, definitely, Imdex. These types of businesses have all kind of demonstrated that, right? Like a shift in the mix of revenue that they get. Probably, maybe RPMGlobal is the most pronounced in how it just kind of went, that's it, we're doing this, and it's going to take a few years, and it might look like we're not growing because we're not taking the huge upfront revenue.
And I think that's the key. I think there's got to be, when you're buying a stock, you've got to say, well, what do I know? What does the market know? And how can I exploit that difference? And, if everyone in the market knows it, then where's the upside or where's the outperformance opportunity? So I think with companies like RPM, where they've gone through a big shift that looks like the business is potentially going backwards, but if you look through the financials, you can see it's just kind of a mixed shift in revenue, then that's where you can buy these kind of companies at really attractive valuations.
Yeah, indeed. Well, let's jump into them because we've got a few companies to get to, and I know that you've done some stuff with Livewire. Luke's done a bit with Equity Mates. So there's different pieces around the traps, but people head to the Seneca website or to goodresearch.com.au, you can find out more. The first business is one that we don't talk about enough here on the show, which is Objective Corp, ASX OCL. And yet, even though we don't talk about it, it's one of the best performing companies in Australia. Can you tell us what it does for folks that aren't familiar? And then we'll dive into the case.
Yeah, it's really under the radar, probably because the founder owns about 65% of the business. So it doesn't trade too much, and it's got no real broker coverage, and they do no IR because, you don't need to unless you're raising capital. And if these guys have, as they do, a strong balance sheet and profitable business, there's no real need to shout from the hills. So basically, Objective Corp is a software provider for governments and heavily regulated industries. And so they've got three kind of core product lines. The main one of that is document management software for government customers, and that's about 70% of revenue.
Mm-hmm.
It's one of these companies that once you're entrenched in governments, and this is all levels of government in Australia, it's really hard to get out of. And I think over the last sort of 5 to 10 years, they've been able to kind of keep winning new contracts and also increase the value of existing contracts sold to customers. And, if you're dealing with kind of a legacy, antiquated, service provider, which, it's government is hardly at the cutting edge of technology, then it creates a really sizable opportunity for Objective Corp. So, they've been one of these just really under the radar kind of quiet compounders. And that's the kind of thing that we like to look at all the time. But I suppose, why is it interesting now? The share price kind of has pulled back over the last couple of years, particularly in the 2022 period where software and tech was selling off as more of a macro theme. And shares pulled back to probably $11 or $12. It's kind of when we started, doing the work again on it, just refreshing our kind of understanding and numbers of the company. And bought some shares sort of shortly after that. And it's a company where, probably the longer you hold it, the more the odds are in your favor, because they're doing a buy. They've got about 100 million of cash. It's about 1.5 billion market cap. And as the business generates cash, they just buy back shares. So the free float's getting tighter and tighter.
Pushing up the share price.
And you've got, continued, it's accretive to the earnings per share. So it's kind of one where we're happy to stick in the bottom drawer. I think we wrote it up for good research subscribers at about $14 or so. And it's now at 17. So it's going well, and it doesn't look too cheap. It's still trading at a 32% discount to Technology One, T&E, on a valuation basis. So yeah, that's a bit of a market darling and kind of shows you the upside of when you do become a larger stock where you're heavily owned by institutions and you got passive money in there as well, what the re-rate potential is, I suppose.
Yeah, that's a good point. So that's a business that Tony Walls, so he owns like 65% here. As the company keeps buying back shares, you would expect he's slowly going to keep ratcheting up that percentage ownership, very slowly, I'm sure. But the next business is a business that has kind of, through the chair actually, of all people, has kind of got some sort of roots in its kind of legacy, which is Catapult, which creates those GPS things that sit on the back of your shirt and you see them in professional sports and that sort of thing. This is a business that's been through the ringer, probably more than twice.
Yep.
Like, what interests you about it?
Well, yeah, I actually at a previous job,
yeah,
we covered Catapult and it was, positive rating. Stock was trading at $2 or $3, and the price target was really aggressive, and everyone was talking about, you've got all these growth tailwinds and good technology and blah blah blah, and it was just burning money. Directors probably sold a few shares. There was a few kind of question marks around headcount. And yeah, the share price really peeled right back. And again, in that sort of 2022 technology bear market. And yeah, I can't remember exactly how low it got, but I'm pretty sure it was maybe under $1.
I'll bring it up.
Yeah,
70 cents.
70
cents. It's now $3.56.
Yeah, so I think the key with this one is that the tailwinds are stronger than ever, but it's really the change in the business that has driven the re-rate. So these guys are a market leader in the wearables. You see it on the back of the sports bras that AFL, NRL, EPL players wear, and so they've kind of dominated that market. Pretty inexpensive product though. You're talking about $20,000 subscription for organizations that are worth many millions, sometimes many billions, and your top players might be on 20 or 30 million in some of these big overseas leagues. So to ensure that they're being looked after, it's a small price to pay. And yeah, so Catapult's kind of one of these interesting ones where now everyone's talking about those growth tailwinds again. I mean, I think they were always there, but it's really the shift in the business. So the tailwinds, I don't know if there's many sports fans out there. I'm a big sports fan myself. And you sort of start to see it around you. You see the streaming rights and the ratcheting increase in streaming rights value, which means more revenue for the teams, bigger budgets to be able to spend on, technology to try and enhance your chances of winning, which is crucial to building team value and brand value. But also some of these things that are kind of just under the radar, like sports betting, like that needs live data. And, Catapult's one of these kind of providers that can tap into that space. Women's sport, like I really enjoyed watching the Matildas at the recent World Cup, and you start following, the players in the Matildas squad when they're playing in their own overseas leagues. And those overseas leagues are getting more and more fans and attendance, and that's a real growth area for all leagues really. And that's just a bunch of new teams where Catapult's potential customer base lies. So yeah, it's a market growing probably 20% per annum. Catapult, we estimate, has about 18% market share, but is a category leader in an underpenetrated market. And it had its most, so the last couple of results have been good, which has seen that share price re-rate. They've reined in the cost base, and the incremental margins is probably the one final point to make, is incremental profit margins 75% for Catapult. So if they can keep growing from here, you can start to see the profitability really inflect. And so that's kind of what's being priced into the shares now. I am reticent that even potentially since we've last had our recording, it's probably rallied a bit.
Yeah, it's probably jumped like 20 or 30%.
Yeah.
20% at least.
Yeah. So I think we profiled this one for good research subscribers at about $2. And I'm starting to get nervous now because I'm seeing a lot of other fund managers talk about it and saying it's the best thing since sliced bread. So that's sort of getting to the point where you might look to take a few off the table.
But it's Will Lopez, is it?
Will Lopez, yeah.
Yeah. CEO came in, Audible background. And it's kind of transitioned. It was already kind of in motion, removing some of those clunky old parts. They made a few botched acquisitions back in the day.
Yeah, I think that's always the market's hesitant when companies have made botched acquisitions.
Yeah. Board hasn't changed really though. Next thing, Jumbo Interactive. You spoke about like sports betting and these types of things before. This is a business we don't talk about a lot on the show. I know you've followed it for a long time. When you and the Dome, aka Luke Larrative, came on the show, he spoke about PointsBet at the time and the under, how that could re-rate because of, you know, various things and assets inside of it, which it has actually. Jumbo.
Yeah, Jumbo, it's exposed to lotteries, so it's primarily a lottery reseller for the Lottery Corp TLC, which is also a listed company. And yeah, if you look at lottery sales over time, I mean, there's a good chart in the Jumbo Interactive investor presentation, which basically just shows lottery sales increasing at 4% per annum roughly over the last 30 years, almost metronomically. So even through recessions, it's really resilient. You know, people are still gonna, if that's what interests you, buy your cheap little lottery ticket and hope for the best. So yeah, Jumbo is just a reseller. They've got an online platform. They did the marketing, and they've got some tech behind it, which enables it to resell these lotteries. And yeah, it's one of these businesses that, because they're not actually taking on the risk of the game, they're more of a marketing business than a bookmaker, so to speak. So it's one of these businesses that if you screen for, you know, certain metrics that you look for in a company, it's got return on equity that's best in class, NPAT margins, which are really healthy as well. And yeah, it's one of these businesses where it's actually grown its dividend consistently over, you know, a long period of time. So if you can buy one of these businesses that's compounded its earnings at such a strong rate, and it's still paying must be 4% fully franked dividend yield at today's prices, that looks pretty good. And one other thing is, another founder-led business. So we kind of talked a bit about that, but yeah, it's another one that's doing a buyback. So, you know, join the dots. It's kind of, if you're heavily incentivized, skin in the game, then you're going to look after the best interest of shareholders.
So it's kind of like a play on the technology and the platform rather than the actual games and lotteries themselves.
Exactly. So it is exposed to volumes slightly, which is why kind of the share price has been a bit volatile over the last couple of years, because you had a big run of jackpots in Powerball last year, which have dried up. So that's kind of when I started becoming interested in it. And we looked at it at Seneca, is because, you've got, the business is unchanged. It's really just the cyclical element that's what's driving sentiment. And it's sold off on some guidance. And we thought we were buying a company for $12 that is probably worth 15 or 16 with a bit of upside in these small parts of the business, which is they're trying to outsource their technology to overseas markets and do some charity auctions and lottery kind of systems as well. So it's kind of just a free option on that growth from our perspective. So that's what kind of gets you the attractive valuation and buy some shares.
I remember when I was back at the Motley Fool days, someone recommended Jumbo Interactive back then. This was would have been I feel like 2012, 2013. And I was just looking at the share price back then. It was way under $2 somewhere. Now it's $14, got a generous dividend. It's been a
really good performance, but I think primarily on the back of just signing one or two really good deals.
Yeah. But I think there was a moment there in time because it rose really. I remember, this is from my limited history, in the early 2010s, it rose dramatically and then it fell for a few years. So the chart now looks amazing. But I'm pretty sure, did they have German assets or a German business or a European business?
Yeah, I think there's been a bit of, moving parts when it comes to offshore activity. And it's always a risk when companies go overseas, isn't it?
Yeah. The next company is a company we have talked about. I think you and I may have even talked about this on the show, which is XRF Scientific. I'll get you to tell us exactly what XRF itself stands for and spell that out for us. Just kidding. But can you tell us a little bit about this business? Because we've spoken about it a bit, but not enough people know about this really cool small cap business. This is a lot smaller than the others that we just talked about.
Yep. First of all, I'd ask you, Owen, how many businesses can you name me that over the last 5 years have compounded their earnings per share at over 30% per annum?
5 years.
And I won't let you say PME because that was the first thought that I had when I was thinking about this.
Yeah.
I think there'd only be a handful, and especially only a handful that trade at a, sub 25 times PE.
Maybe Altium, which got bought out. Maybe,
but I reckon even then you're paying 50 times earnings, 40, 50, depending on how you slice it.
Xero didn't have any earnings 5 years ago. Objective Corp, maybe
Objective
because
Corp,
maybe it's bought back enough shares, so it boosts the EPS line. I don't know that many.
There wouldn't be many because 30% is high for a sustainable number, especially over 10, 15 years, there's virtually none. And so basically XRF is one of these companies which has always been kind of, I'll first of all explain what it does, is it does laboratory testing equipment and consumables for mining and industrial customers. And that sounds, bit boring maybe, but the key to this business is they sell, it's like a razor and blades model. So you sell your testing machine, make maybe a small profit margin if you're lucky, a bit more competitive in that side of things. And then once you'd start testing your samples, be it iron ore quality, BHP's doing their samples, or, any of these mining customers that go through the big lab groups like ALS, Intertech, SGS, and you basically have to blend chemicals, lithium tetraborate. So I won't go too deep into that.
Oh no, please keep going.
I actually might ask you to spell it out. But no, it's a unique blend of chemicals for every different ore body. So basically XRF seems like a boring industrial company, but it's actually got some IP behind it. And myself and the Dome were out there about a month or two ago, and we checked out the facilities.
In Perth, you mean?
In Perth,
yeah.
Yep. As we like to try and get out and see things in person rather than just do desktop analysis.
The old podcasts.
Yeah, exactly. But yeah, we were really impressed with management. We've always been impressed by management. They're super shrewd. Over the last few years, Vance, great operator. Honestly, I've listened to Vance on probably quarterly conference calls or broker calls for the last few years, and every single time he says the same thing, which is that, business is going well, we're developing new products which are coming to market soon, and maybe we'll look at disciplined, accretive M&A if the right sized or the right opportunity comes to them. And every single time I listen to the other fund managers on the call kind of angling for a cap raise. How do I get set in this? Because, it doesn't trade heaps. It's probably over 200 mil market cap now, so a bit more, but it's never been like you can't take a big swing at a company like this. And I just love that answer. I love the disciplined approach to M&A. And they actually did an acquisition last week.
Oh, last week?
Yeah. So there was an acquisition probably a year or two ago.
Which is for the crushing machines.
Crushing machines, which basically crush a sample of gold in one single pass. Competitors do it in two. It's pretty nifty tech they've got. And they've got the existing relationships with all the customers in the lab group. So easy to sell it through their existing distribution network at high incremental returns. But the acquisition last week, it's just classic XRF. It's small, so it might not be like a huge needle mover. It's, no equity raise to fund it. And yeah, it's just another lab product that they think is good down in Bayswater, where they also have a facility down here in Victoria. And yeah, they reckon they can do the same thing, plug into the distribution network and give the vendor some, performance milestones and yeah, keeping on. So it's a slow and steady growth story, and it is exposed to mining volumes, but I don't think it's exposed as people think, and that's kind of been the key re-rate opportunity over the last few years.
Yeah. Now that they're in Bayswater, Ben, we might have to drop around and see what. Just peer over the fence and maybe bring your hard hat, and I'll take mine. I think I've got a few here in the office.
I'm trying to get the Dome to buy customized high-vis vest with the Seneca logo on it, but it's a work in progress, that one. Surely
you can afford it now with how you guys are doing. Bring it up.
Maybe after one or two more good years.
Okay, so that's XRF, and the ticker symbol is surprisingly XRF. It stands for X-ray fluoroscopy. There you go. RPMGlobal, Runge Pinnock Monaco, I think was the original name. So it's now RPMGlobal, which trades under the ticker symbol RUL. is also probably, if PME is like the child that we all love on the show, I'd say RPM is like at least the third child. So tell us a little bit, folks that are catching up on this story, what is the business and why is it interesting?
Yeah, RPM is software for the mining industry. And I think it's one of these ways to play the mining industry, but with more of a software tech approach, slightly probably less cyclical. They've got a huge diversity in customers and types of mine, types of commodity. But yeah, RPM has basically spent the last decade building and acquiring different software products for kind of different applications within the mining vertical. Because if you think about mining, it's, a costly, complex operation where you've got to manage people, you've got to manage equipment, you've got to manage your mine plan. And if any one of those things is not going well, then the mine typically, can decline in profitability and lose money, and obviously not good for management or shareholders. So you can sell these software products, which can add a lot of value to these operations. RPM has some really good asset maintenance, equipment maintenance software, which basically tracks how, your trucks and diggers are going relative to their depreciation or their kind of requirements for maintenance, stuff like that. So, but there's also, mine planning, there's ESG, there's a bunch of different products. And I think that's where RPM's kind of differentiated itself in the market, is it's a one-stop shop solution provider. And I think why it's been a bit of a favorite for the show and friends of the show is that, they've gone through this subscription revenue transition where, they took a bit of a hit to profitability over the last few years. And now they've gotten to that critical mass point where most of their revenue comes from subscriptions, and, they're primarily large miners as well that aren't shutting down anytime soon. So there's a level of confidence within the market that growth or that profitability is now sustainable. And again, like with some of these other examples we mentioned, the incremental margins from here are really strong. So yeah, you're starting to see some really outsized profit growth. And relative to these larger cap software players, RPM's pretty attractively valued and attractive relative to even transactions in the space. So
Google Finance has got a PE ratio of 82.8.
Oh, don't believe everything you see on Google Finance, Owen. But this is the thing. Google Finance will look at NPAT in the previous financial year completed, I believe.
Yeah, I don't think it's normalized either.
Not normalized.
It's just statutory numbers, which would be a mess.
Exactly.
For something like this.
Yeah, particularly if you've got a big whack of amortization because you've acquired things. And that's a conversation for another day. But if you look at probably the next year and the next two to 3 years, that's when you start to see the valuation come right down. And even if you look at, say, EV to EBITDA, that's where you can see big discounts to peers.
You've, in your email to me, you provided a lovely little chart here. And since 2018, because Richard Matthews got involved, CEO Richard Matthews got involved in 2012, 2013, and he bought a big chunk of shares. And since then, basically embarked on this mission to make it a tech company, because it already had little bits of tech here and there alongside its consulting. But it's basically all subscription now.
Yeah, and it was all consulting kind of.
Yeah, so it went from nothing 6 years ago to everything, which is insane. Because as far as I'm aware, the term of the subscriptions are 3, 5, 10 years kind of thing, in that range somewhere.
Yeah.
So that's pretty incredible.
It is. And yeah, I mean, you'd mentioned CEO Richard Matthews. I'm going to sound like a broken record, but aligned management, buying back shares, growing earnings. So recipe for success in our view.
The final one is one that we don't talk about as much. It's kind of like the slightly bigger brother. Did you know that RPM Global's up 100% in the last year?
I did know it.
You probably know that. I'd expect you to know that.
But it's still surprising, isn't it? I think it just goes to show that, you can be wrong about things for a few months, 6 months, or even a year. And if you've got the conviction, sometimes it can move in a hurry. So it's happened with multiple of our stocks. You're wrong until you're right.
Speaking of WiseTech's also $130. I remember saying no at 20. Anyway, we'll move on. The last one is the bigger brother of RPM, but I say that because it's similar, but it's very different, which is this business Imdex with an IMDEX. So the ticker symbol is IMD. What does it do?
Yeah, so this is a bit more in the mining space. It's tools for drilling optimization. And again, when you think about the costs in mining, especially at the earlier exploration and development stage, it's really important to get accurate ore body knowledge. So if you drill a hole which can cost, a few $100,000 to $1 million, depending on what you're drilling for, if you drill a hole and you hit some gold or whatever it is, and then it's more gold and it looks like it's going to become a mine, and then you go to start mining it and it's actually not as much gold as you thought was going to be there, then you run into major problems. So basically, Imdex provides the tools and sensors that, in terms of orientation, which direction is the ore body going, where is the mineralization is essentially the key question. So again, it's kind of a small cost component in a larger supply chain, similar in the sense like XRF, RPMGlobal. And yeah, I suppose the key attraction for Imdex is, yes, it's a bit more cyclical than a couple of those others, but if you look at the gold price and the copper price, they're up big, particularly the gold price over the last 12 months. And yet exploration volumes are kind of haven't really, like they're still at their lows. So the leading indicators of essentially like Northern Star and large gold companies undertaking more development, exploration, drilling is, first of all, financings, if they've got the money to do it. So you think these producers have all been making good cash flow over the last 12 months, and juniors will have been able to raise some money. And the commodity price is obviously the lead indicator into financing. So I think what you're going to see is recovery in exploration volumes. And yeah, that's our kind of cycle view. But from a structural perspective, we think Imdex is one of the best ways to play it. Good valuation upside, as well as a couple of these others like XRF and RUL.
You've got a note in here and it says, fund managers who can't invest in miners will invest in Imdex, end quote.
Receipts. You should have pulled up the receipts here. Yeah, because if there's a mandate, well, we don't do mining and commodities are ripping, then
they have to do something.
They have to own something. And so they pile into Imdex. It was $3, went from $1 to $3 probably a couple of years ago in a hurry. It's now $2.50. We think there's troughing volumes. I think it could get to $3.50, $4 if we see volumes turn, because fundies, yeah. That's, again, it's a conversation for other days, but fundies are like, I feel like rats on a ship, and they'll just sort of jump from one side to the other and back again. And there's often no change to the underlying fundamentals. So you just got to play the market sometimes.
Rats on a ship. See, but you could say that, I guess, because you are one now.
Yeah. I'm just another scurrying rat at the end of the day.
Oh, gosh. All right, serious question. If you were looking at Objective Corp, Catapult, Jumbo, XRF, RPM, or Imdex, I'm not going to do buy, hold, sell, but if you were listening to this episode and you enjoyed it, which why wouldn't you, of course, Ben's here. Which one would you tell someone to start researching first?
Yeah, that's a good question. I thought you were going to ask me which would I own for 5 years, but I like that version of the question.
Well, I can do that next.
Yeah, okay. I would start researching first XRF, I think, just because some of the others are relatively more well-known in the market. And I think at 200 or so mil market cap, you can still get a lot of value for that research. And just thinking about it, I think you've done a lot of work on XRF and the share price goes up a little bit, you might say you'd be tempted to cash out and be like, well, it's more well understood now. I think it's important to realize that not many people have done the work on these smaller companies, and probably it's still a new idea for 99% of people out there, maybe 90% of investors. So yeah, that's one I'd start on.
I have some other short answer questions that I'm going to ask you, and you can just fire from the hip. Who's the best CEO you've come across?
Yeah, good one. We're fortunate enough to meet with a lot of management teams. XRF is front of mind, maybe recency bias, but really impressive. GDC is another one which listeners would be...
Yeah, from last time.
Would have heard me talk about. He's a good operator and had some really good incentives in place. But then, yeah, plenty of the large cap guys are hard to go past. Sam Huppert, Pro Medicus, etc.
Yep. If you could buy one of these companies right now, but you couldn't check it for 5 years, which one of the companies that we've talked about today would you go with?
Probably Objective Corp, because in terms of, you can't sell it and in 5 years you're confident it's going to be in a better position. I think they've still got a long runway for growth. Within each of their business units, they've got, favourable dynamics. They're shifting more profitably. And I think the management's going to keep buying back shares and you'll do well there over the longer term.
Final one, the best business model that you've come across. So not business, not stock, business model. And it doesn't even have to be something you've invested in. It could be something you read about.
It probably comes back to just recurring revenue from a customer that you own the relationship with. I suppose that's why I'm in the business that I'm in, or, Luke's in the business that he's in. But also you think of all the great businesses, Spotify, Netflix, it's just cost of doing business, cost of living almost. And Apple, another one, owns the customer. You're always going to buy an Apple iPhone. So I think that's the best business model. I would caveat, there's another really interesting business model I've been looking a lot at recently, which is royalties. Won't go too much into it, but I think there's a couple of really interesting companies in that space.
Okay, cool. So folks can follow the link in the podcast player or in YouTube. You can check out a free sample report. All you've got to do, and you could just do this right now, is email hello@goodresearch.com.au and you can request the free report from Ben and Luke and the team. They'll send you a PDF version of their latest note. Now, Luke's banged on about this enough to me, but about good research, the idea is that you share the research that you're doing yourselves, but obviously it's small cap, so you can't share it with too many people before you'll close it. But it's only just launched, which is pretty cool. And if you want to book a meeting to invest with Seneca, Ben here, Luke, etc., you can do that via the link in your show notes. Ras doesn't make anything from it. It's just if you want to book it in, these guys are laser focused on finding aligned investors. So if you like what you heard today, check them out. Mate, this has been good to do it in person, so way better than doing it through some computer screen.
Agreed. Stupid technology.
Stupid. Who needs computers? Anyway, mate, this has been a heap of fun, so thanks for joining me.
Mate, always a pleasure. Appreciate your support.
Thanks for watching this video on the RAS Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.